Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. When my kids were younger, we used to go hiking. And every time, one of the three of the kids would end up lagging behind. They were tired, or they were bored, or maybe they got distracted by a butterfly or a pretty flower. It was always something. But you know what? They always caught up. Never once did we leave a kid in the forest. Although I gotta admit, sometimes it was kind of tempting. Well, gold is on a hike right now, and it's keeping up a frenetic pace. Its little brother, silver, lagging behind, or at least that's the perception. And I gotta be honest, a lot of people are worried about little brother. But I have a feeling he's gonna catch up. At least that's what history suggests. Now, it's been yet another crazy week in the gold market. Yesterday, the spot price drove into the low 3480s, and gold futures briefly touched $3,500 an ounce before profit-taking took over during the day, and a recovery in stocks kind of pushed the price of gold down later in the day. But here's the thing that's really been interesting to me about this gold bull. Just when you think that the rally might be running out of steam, it ramps back up again. Consider this. Since the beginning of the year, the price of gold is up by over 25%. That's on top of a 26.5% increase in 2024. The yellow metal is by far the best performing asset of 2025. So what's driving this bull market? Well, there's a lot of things. A lot of factors are going into this. We've talked about them. Central bank gold buying has really put a floor on the gold price for well over a year. You have de-dollarization going on. You have a lot of countries that are starting to spurn the dollar and they have to replace it with something, so gold. You have the trade war. You have a lot of geopolitical uncertainty. You've had wars. You've had inflation. My friend and analyst Brian London made a really good point in a recent article that's published over at moneymetals.com/news. Anybody who focuses on any single factor behind gold's recent surge is missing the big picture. Brian wrote, "Gold has been telling us that it's not one thing, it's everything." And, that's kind of a hallmark of a bull market, as Brian mentioned. Every new data point is interpreted bullishly. And I think we have a lot of that in play right now. And, underlying all of these factors is a point that I've been hammering on week after week after week here on the show, and also in the articles that I've been publishing over at moneymetals.com/news. The Fed has created this big, fat, ugly bubble, and they've been blowing this bubble up really since 2008, and then they did it with gusto during the pandemic, and we still haven't experienced all of the fallout from this monetary malfeasance. And I'm going to quote London again. He says, 45 years of ever easier money and ever greater debts have built a debt trap that cannot be escaped without a major devaluation of fiat currencies around the globe. So if fiat currencies are losing value, what happens to the price of gold, which is what they're priced in? Well, that price is going to go up, reflecting the devaluation of the currency. And here's the thing. There's no way out of this mess. At least there's not a clean, easy way out of this mess. That's the nature of the boom-bust cycle that is created by Federal Reserve monetary policy. They blow up a bubble, and ultimately the bubble has to pop. You have a boom, and then you have a bust. And the bust is usually on the same scale as the boom. So the bigger the boom, the bigger the bust. Well, we really haven't had the bust that has been coming really since the 2008 financial crisis, certainly since the massive level of quantitative easing and easy money that we saw pumped into the system during the pandemic. And, for the last several months, if you've been listening to the show, you know this, I've been talking about the fact that the Fed is in a catch-22. That was reiterated this week when President Trump went off on Federal Reserve Chairman Jerome Powell again. In a Monday post on Truth Social, Trump said, many people are calling for preemptive cuts. He's talking about interest rate cuts here. And he claimed that there is virtually no inflation. Trump wrote, with these costs trending so nicely downward, just what I predicted they would do, there can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates now. So I'm not going to go into depth on this subject again on the show because basically that would make it a repeat of last week's show, and there's no sense in doing that. But I will link on the show notes page to the article I wrote about Trump's comments and how this just really reflects this catch-22, right? You've got a central bank that needs to hold interest rates higher for longer because it created all of this inflation. And even though prices are coming down a little bit, at least based on the CPI, there is still all of this inflation in the system. They never wrung it out. They never got rid of it, not after the 2008 financial crisis, and certainly not after the pandemic. So all of that inflation is still there. So they really need to hold interest rates higher for longer. I would actually argue that they need to raise interest rates to really put the inflation monster to bed. But they're not going to do that. And of course, simultaneously, they need to cut interest rates. Trump isn't wrong, right? And in the article, I explain exactly why Trump is jonesing for these rate cuts. Now, he's wrong that there's virtually no inflation. Hint, while prices have gone down, the money supply is going up, which is by definition inflation. And that's inevitably going to lead to higher prices in the future. But Trump will probably get his wish because the Fed is in this catch-22. They simultaneously need to lower and raise interest rates at the same time. Well, good luck with that, right? That's not a thing. There's no easy way out of this. We are heading down a dead-end street. It's like those horror movies where the guy's being chased and he runs into the dark alley and then there's a fence and he's trying to climb the fence and the monster grabs him by the leg. That's pretty much where we are with this economy. There are some major cleansings that need to happen in the economy, and it's going to happen at some point. Anyway, you can read that article over at moneymetals.com/news, or again, I'll post it on the show notes page. But that really kind of sums up what has been going on this week. So let's talk about silver, right? As gold marches ever higher, silver continues to lag. Like my kids on a hike back in the day, when they became more interested in sniffing flowers than keeping up with our pace. Now, don't get me wrong. Silver hasn't done horribly so far this year. In fact, it's up a little over 12%. So that's not a bad return. I mean, especially when you consider we're only in April, right? A 12% gain in 4 months isn't too shabby. However, silver has failed to close the gap with gold. We saw the same thing last year. Silver was actually up almost the same percentage as gold was. But because silver's not setting new records, because it's nowhere near its all-time high, there's this sense that silver just hasn't done well, that it's a laggard. And that has a lot of investors questioning what's going on with the white metal. In fact, I would say every week somebody will ask me, "Hey, Mike, what's going on with silver? Why isn't silver caught up? What's up with silver?" So when I was prepping for this show, and this was actually yesterday, the gold-silver ratio was just over 103 to 1. So what that means is it takes roughly 103 ounces of silver to buy 1 ounce of gold. And yesterday morning, that number was actually as high as 104 to 1. And I'll just tell you up front, that's not normal. Now, I've talked about the gold-silver ratio several times on the show, but it's worth covering this again because, again, virtually every week somebody's asking me what's going on with silver. Why is it such a laggard? And to do that, you kind of have to understand the history. You have to have the historical background, which will help you understand what's going on with silver today. So to put a 103 to 1 gold-silver ratio into perspective, that is slightly above the peak in 1991, which was the second highest peak all time. And it's not too far below the all-time high gold-silver ratio, which got to 123 to 1 during the pandemic chaos in 2020. So we have this anomaly in the gold-silver ratio, but so what? Well, it's an extremely wide spread from a historical perspective, and that indicates that silver is drastically underpriced compared to gold. I like to call it silver on sale. More significantly, these extremely wide gold-silver ratios don't tend to last all of that long. They certainly don't last forever. They eventually snap back to the mean, snap back to the average. And when that happens, it's generally a very fast move. You'll see that gap close very quickly within a matter of weeks, months at most. So let's put this into some broader historical context, and maybe it'll make a little bit more sense. Now, keep in mind that gold and silver are both fundamentally monetary metals, right? Even though silver hasn't been part of any monetary system for many, many years, people still intuitively recognize that it is money at its core. Think about it. If somebody offered to pay you for a job in ounces of silver, would you do it? Of course you would. I mean, if you say no, you might want to rethink that. Somebody could give you $1 in pre-1965 quarters, so 1965, pre-1965 quarters, when they were made mostly of silver. And if somebody did that today, you would be holding in your hand over $23 in melt value for the silver. So I once got paid by a guy $200 in silver coinage for a job that I did. He paid me in old silver dimes and quarters. That today is worth about $4,700 when you look at the melt value. So that's a pretty good deal, right? He paid me $200. He gave me this silver, but in essence, he was paying me a lot more than that because the value of the silver was worth far more than the face value of the coins. This really reveals how much the government has devalued your money just since the 1960s. But anyway, I say all of this to underscore the fact that silver is money. You know, if the fiat system starts to crash, I guarantee you will be able to find people out there who will take silver as barter. They will take silver in exchange for stuff because they recognize that silver has all of the fundamentals that make good money. However, about 50% or more, I think it's getting closer to 60% today, of the demand for silver is for industrial uses, primarily in electronics, solar panels, green energy, those types of things. So the fact that there is this industrial demand makes the silver price a lot more volatile than gold. Because think about it, the supply and demand dynamics are being impacted by the industrial demand. So if economy starts to get shaky, people are buying fewer electronic goods, you'll need less silver in the electronics industry. That will put a lag on demand. So you can see why there would be more volatility. You can see why people get more worried about a recession, or as people get more worried about a recession, that you would see the price of silver dip a little bit because they're thinking, well, there won't be as much industrial demand. But still, despite all of this, silver tends to track with gold over time. And therein lies the value of the gold-silver ratio. Basically, gold and silver are attached at the hip, but silver will make a smoother move up or down, while gold will make a smoother move up and down, while silver will have this jaggedy, more volatile movement. But still, over time, they tend to track together. And when the relationship between gold and silver, which is reflected in this ratio, gets out of whack, it's telling you something. So looking at the gold-silver ratio over time kind of helps you understand where I'm coming from. Mining industry geologists will estimate that there's somewhere between 19 and 20 ounces of silver for every ounce of gold in the earth. So this is a natural starting point for a gold-silver ratio of 20-1. From a mining perspective, annual silver production averages somewhere in the 800 million ounce range. And gold production is a little over 100 million ounces. And these are round numbers, of course. So that would give you a gold-silver ratio of around 8-1. You can go back through time and you can see that when silver was much more heavily monetized than it is today, when it was actually used as coinage and as part of the monetary system, government would set gold-silver ratios to control the value of their coinage. So the earliest recorded imposed gold-silver ratio was by King Menes of ancient Egypt, and he set the ratio at 2.5-1. So 2.5 ounces of silver was equal to 1 ounce of gold in that ancient Egyptian economy. Moving ahead, way ahead in history, the U.S. Congress fixed a gold-silver ratio of 15-1 in the 1792 Coinage Act. And that was kind of standard in the global economy because we can go to France in 1803, just about 10 years later, and they set their ratio at 15.5-1. Ultimately, this bimetallic monetary system using both gold and silver proved to be unwieldy, and European countries began to demonetize silver in the mid-19th century. The U.S. followed the lead of England, Portugal, and Germany and other nations and established a gold standard only in the Coinage Act of 1873, although it still used silver in the production of dimes and quarters, half dollars, as I've already mentioned. So the demonetization left gold and silver to kind of float freely. So the ratio kind of started to expand as silver was less monetized. And by World War II, the gold-silver ratio was kind of averaging in around the 40-1 range. And in the modern era, since then, the gold-silver ratio has been around 60-1. That's kind of the number that we look at today and say that's the mean, 60-1. So when you see 103-1, that's an anomaly. That's way outside of that historical average. So what is this telling us? Well, it either means that silver is way undervalued or gold is way overvalued. Now, given the constant devaluation of fiat dollars, and not just dollars, yuan, euros, yen, all of the government fiat currencies, they're all being devalued by their governments. It's really hard to argue that gold is overvalued, right? In fact, I would argue that gold is significantly undervalued as well. It's just not as undervalued as silver. So here's the thing. As I already mentioned, when the gold-silver ratio gets way out of whack like it is today, it eventually snaps back to that average. It's very important to understand that. We see it over and over again throughout history. So when you see this gold-silver ratio well above the historical average, it tells you that silver is underpriced compared to gold, typically. And there is a strong possibility that silver is going to go on a run to close the gap. And historically, this has often happened in the midst of a gold bull rally, with silver outperforming gold. Now, of course, you should always say this when you're talking about anything in the world of investment. Past performance does not guarantee future results. But as the saying goes, even if history doesn't repeat, it often rhymes. And I'm not going to bet against a historical cycle that we can trace back for years and years and years and years. Lau Veges, I think I pronounced his last name right, Veges. He's an analyst who writes for Doug Casey on his crisis investing website. And he wrote about the gold-silver ratio recently, and he made this very point. He said, quote, "Historically, extreme ratio levels, like 103 right now, have often preceded significant reversals, with silver typically outperforming gold as the ratio reverts toward its average. A clear recent example was March 2020. After spiking above 120-1, silver more than doubled in price within just 5 months, substantially outperforming gold." And when that was all said and done, the ratio was back to 60 to 1. So we saw that snap back during the pandemic years. We've seen even more dramatic snapbacks in the past where the ratio even goes the other way and gets historically narrow. The gold-silver ratio fell to 30 to 1 in 2011 after rising to over 80 to 1 during the money creation of the Great Recession in the wake of the 2008 financial crisis. Again, we saw a gold bull rally. We saw silver lag early on. Then we saw silver outperforming gold in the later stages of that gold bull run. And this has been kind of the typical historical pattern. Gold goes first, silver lags, then it catches up, and it brings that ratio back into more of a historical norm. Now, I've talked to some people, and they've suggested that the gold-silver ratio is broken down, that it's not relevant anymore, that we shouldn't look at it, that it is a ancient relic, and it doesn't really tell us anything in this modern market. And they say that because the fact of the matter is we've been well over the 60 to 1 average for well over a year. I wrote several articles last year about the gold-silver ratio being in the 80 to 1 range. So now we're even way above that. And I was saying at the time, 80 to 1 is out of whack. It's a historical anomaly. But when people tell me this, and they say to me, Mike, the gold-silver ratio just doesn't matter anymore. It's just something in the past. Don't worry about it. Whenever they tell me that, I'll ask them, what structural change in the gold and silver markets would explain such a breakdown of a historical ratio? And nobody's ever been able to answer that question. I don't think there is one. I'm open to hearing about it if there is, but I just don't see any reason to believe that the ratio is broken down and that it's not telling us anything. I just think this has been a longer than normal period where the ratio has been out of whack. But I don't think that it's telling us that the ratio doesn't matter anymore. Veggie suggests 3 reasons why the gold-silver ratio tends to return to the mean. And again, I don't see any reason. I don't see that any of these 3 reasons have changed, that they're not relevant anymore. Number 1, the silver market is relatively small. It's about 1/10 the size of gold's market, which means that even modest capital inflows can move the price dramatically. That's why you see the price swing very quickly when the bulls grab the handle. Number 2, silver tends to be more volatile, often behaving like a leveraged version of gold. During bull markets, it usually outpaces gold significantly. And I'll add to that silver run tends to happen later in a gold bull market. And then he says, number 3, unlike gold, about half of silver's demand is industrial. I've already talked about that. So as economic activity rebounds after an economic downturn, this industrial usage picks up and it provides additional price support. So it's worth noting that the silver supply and demand fundamentals right now are extremely strong for silver. And industrial demand set a record in 2024. That drove the 4th straight annual market deficit, where silver demand outstripped supply by 148.9 million ounces. And that drove the 4-year market shortfall to 678 million ounces, the equivalent of 10 months of mining supply in 2024. So in other words, you've got more silver being used than what is being dug out of the ground or produced through recycling. And when you have demand outstripping supply, that means that the market has to tap into existing reserves that are already above ground. And to do that, it usually requires a price to go up, right? There's a lot of silver above ground. There's plenty of silver in existence, but a lot of it is in, bars, it's in jewelry, it's in ETFs, it's in bank vaults. And for that silver to be brought into industrial production, then the price has to be right for those people who are holding it to let go of it. So we're in a situation where we should start to see the silver price responding to these supply and demand dynamics. And what's interesting is I was talking to a mining CEO today, the president and CEO of Majestic Silver, and you'll be able to listen to that interview on Friday over on our other podcast. But he was telling me that he thinks that the Silver Institute is dramatically understating the situation, that the supply and demand dynamics are even better, that supply deficit is even bigger than what is being announced and made public. But since the Silver Institute, that's the official numbers that we have to go by, we'll just go by that. And even at that, we see this significant lack of supply and rising demand. And, basic economics tells you that should begin to cause prices to go up. And also interesting to note that this supply or this market deficit happened despite very tepid investment demand. In fact, the biggest drag on overall silver demand last year was in the investment sector. Coin and bar demand plunged by 22% to a 5-year low. And Western markets, US and Europe, reported the biggest sag in demand with double-digit declines across the board. The steepest drop was in the US, where silver investment demand crashed by 46%. So we still saw a healthy increase in the price of silver last year. We've seen a healthy increase in the price of silver through the first 4 months of this year, despite investors kind of sitting on the sideline. This has been almost totally driven by industrial demand and then some investment demand in Asia. Imagine what that's going to look like if Western investors step into the arena, right? According to the Silver Institute, profit taking at higher prices, market saturation, and optimism about a Trump presidency is what created headwinds for investment silver in the U.S. Well, a lot of those dynamics are falling apart. I think there's much more uncertainty in the market. We've got worries about the trade war. We've got worries about a recession. So I think that we have the potential to see these supply and demand dynamics swing even further in favor of the silver price going up as investors begin to get interested. And I tell you what, if the economy goes into recession, like I expect it will, if inflation remains a problem, we end up in a stagflationary environment, which I think is entirely possible. There's no telling what that will drive the price of silver to. We could see some extremely interesting runs up in the price of silver. And again, talking to Keith Neumeyer over at Majestic Silver, he said that we really need triple-digit silver prices in order to put the market in balance. So something to keep in mind. Now, again, stop and think about this. When investors get in on the action, and they will, that supply-demand gap could absolutely explode. And silver simply isn't priced for these market dynamics. So going back to Vegas, he sums up the situation this way, quote, "Here's the bottom line. With the gold-silver ratio at such an extreme level, silver looks set for a potential catch-up rally. If the ratio just moves back to its long-term average of 60, silver would need to rise about 70% relative to gold. That's an increase of nearly $23 per ounce from the current level, which would put silver over its all-time high. And of course, if gold keeps climbing as well, well, then silver's upside could go from big to explosive." And he also makes an important point to those who speculate that the gold-silver ratio has somehow become irrelevant. He writes, "Extremes can last longer than you'd expect, and history doesn't guarantee what comes next. But at these levels, silver's risk reward looks pretty compelling. So the bottom line is that silver appears to be on sale. And, not to sound like the TV huckster, but these prices probably won't last. Now is the time to take advantage of this historically wide gold-silver ratio. If this ratio is telling us what it has told us historically, we are on the verge to explosive upside in the price of silver. And again, looking at history, when it happens, it's going to happen very fast. It will take a lot of people by surprise. And when it happens, it could be over before a lot of people realize it and get off the sidelines. So you want to act now. You want to have your silver now, right? Smart investing is buy low, sell high. And the supply and demand dynamics and the gold-silver ratio are both telling you that right now silver is on sale. So now is the time you want to take advantage of that. I highly recommend calling 800-800-1865 and talking to a Money Metals, precious metals specialist today. They can tell you what kind of silver products we have. They can answer questions about the silver market if you have some. They can help you more broadly figure out how silver might fit into your investment portfolio. Of course, they can do the same for gold. I don't think it's too late to get in on this gold bull run either. I think given the fact that the Fed is in a catch-22, given the fact that we still have to reckon with the consequences of decades of monetary malfeasance, I think it's also a good time to get into gold. So talk to a Money Metals, precious metals specialist today. Again, the number is 800-800-1865. If you don't want to talk on the phone, you can go to moneymetals.com and chat with a precious metals specialist online. Or if you know what you want, you just want to get some silver bars, you can buy anything from Money Metals right online and do it today. I'm trying to create a sense of urgency because I think this is an opportunity for investors. If you haven't been stacking silver all along, I think you still have an opportunity to get in. But again, looking at history, we should be set on the verge of a very strong rally in silver. So, with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and more over at moneymetals.com/news. If you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up and get on our email list. I promise we will not spam you, but you'll get a lot of good information. Of course, you could subscribe to the Midweek Memo on your favorite podcasting platform. We're also over on YouTube. And when you do, you can also tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people in the world of gold, silver, economics, and investing. I very much appreciate the fact that you've taken a little time out of your day to listen to the show. If you like the show, please go to wherever you listen, leave a review, give us those 5 stars, hit the like buttons, share the episode. That helps us spread the word. Again, thank you so much for listening, and hope you have a great rest of your week. And I'll be back here behind the microphone again next week.